Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 63rd episode, The Truth Behind Mutual Funds. Okay, Jesse, for episode 63, I wanted to have a candid discussion with you about mutual funds. A lot of investors out there, frankly, probably don't even know what they're invested in, but there's a vast majority that are in mutual funds and they really don't even know what the heck they are.
Right.
So I wanted to start our conversation by first defining it, and then I wanted to just go back and forth, and then you and I can kind of discuss what our thoughts are on mutual funds and explain those to our audience.
Sure.
Thank you. And so again, thanks for being back on the show.
Yeah, of course.
2 weeks in a row.
Yeah, thanks for having me.
You're becoming a regular. So what? First off, to define a mutual fund, simply put, is an investment company that sells shares of its fund to investors and takes the money that they collect from investors and pools it together to buy stocks and bonds. So in English, you're basically, when you buy into a mutual fund, you're in there with every other investor, and the mutual fund, believe it or not, has their own investment objective. And that's one of the first red flags that I wanted to talk about, is that when you own shares of a mutual fund, they don't know anything about their shareholders. They have their own investment objectives, whether that's aggressive growth or income or whatever the heck it may be, or trying to beat a certain index, but they don't know their individual investors offhand. And to really understand what a mutual fund's investment objectives are, you need to be reading what's called a prospectus. And maybe you can go over what a prospectus is a little bit.
Yeah, the prospectus is what the objective of the mutual fund is, and it's how they're going to invest that mutual fund. And again, like when you talk about the objective of the portfolio manager is not, their objective isn't to get the best return for the client. The client is really just the mutual fund rather than the people who are buying into the mutual fund. So all they have to do is meet the investment objectives that are set out in that prospectus. And it doesn't have anything to do with the people who are actually buying into the mutual fund.
Yeah, that's a really good point. And so it's very important that if you own these mutual funds, that if you're buying them through a financial advisor, the advisor should be going over the prospectus with you and explaining it. Because again, the portfolio manager, their marching orders are to the fund, not to the people buying the shares. And that's really basically what Jesse said there. So that's good. So that's first off. So again, there's some really good ones in Kansas City. American Century is a really good mutual fund company. Waddell and Reed spun off theirs, I believe, to Ivy. They're another really good one. One of the biggest ones in the country, I believe, is down in San Antonio. It's called American Funds. There are all kinds. Is there some other, Vanguard, I think those are mutual funds.
Yeah, they make ETFs too.
Yep, very big one. What are some other mutual fund companies that people may have heard of?
Blackstone maybe.
Yeah.
All those big banks have their own mutual funds that they sell.
Yeah, Wells Fargo has mutual funds. I mean, so there's a lot of them. And in fact, how many mutual funds are out there?
There's 9,600 mutual funds in the U.S.
Wow, so almost 10,000 mutual funds to choose from. Now, let's compare that to actually how many stocks are listed in the U.S.
So just on U.S. exchanges, there's about 6,000.
Wow, so there's actually 50% more mutual funds, companies, than actual stocks to buy.
Right.
Which is crazy. And some people may ask, why do you think that is, Jesse?
Well, a lot of those mutual funds have the same objective, so they're buying a lot of the same stocks. And I would assume that the difference between them is just the allocation of what they're overweighting or underweighting in those certain mutual funds.
Right, exactly. So a mutual fund could have 30 stocks, it could have 300. One could, and 1,000 of them could all own Google, right? And 1,000 of them could own Microsoft, and Google and Microsoft. So there's all these different combinations.
And they could just weight them differently.
Right.
Technically a different mutual fund.
Yeah, exactly. So there's almost 10,000 of there to choose from. Now, we've talked a lot on our show and with our clients why we despise products so much. But maybe I think before we get into maybe some of the risks associated with mutual funds, maybe you and I should talk about who should be using a mutual fund. Because if there's almost 10,000 of them out there that Wall Street has created, they can't be all that bad.
Right.
Right. So who typically uses a mutual fund, and who should be using a mutual fund? Do you have any ideas behind that?
I would say people who want to manage their investments themselves. I think the problem isn't with the mutual funds per se. I think the problem becomes when someone is selling you the mutual fund and they're getting a commission off selling that mutual fund, but they're not really doing any of the work of creating the mutual fund. So the mutual fund, you have the fee of the person who's suggesting it and then the fee of the mutual fund on top of it. And the person who's selling you that mutual fund isn't making any of the investment decisions.
Right. So it's the intermediary that we have really a big issue with. Is these advisors will charge you an asset management fee, which is typically based on the value of your account. So if your account goes up, they make more money. And if your account goes down, they make less money. So they're trying to tie your investment performance to their compensation. But what you're getting at is if they're not the ones making the investment decisions, why are they tying their compensation to that?
And they're not only not making the decisions, they don't know the decisions that are actually being made at the
right. They have no clue. And before we go down that road even more, so talking about, you mentioned who should be using it is the do-it-yourselfer. Mm-hmm. So if you have a really interest in the markets and you understand that there is real value in somebody selecting stocks and making educated decisions, and you want to have a professional money manager do that, then absolutely you should go to mutual fund companies like an American Century or a Vanguard or an Ivy Funds and hire and go look through those mutual funds and talk to the portfolio managers and make good informed decisions. Another type, I think, of people that should or are oftentimes forced to use mutual funds are 401k participants, right? And almost every 401k that we see out there, and this doesn't apply to all of them, but a lot of them have mutual funds to choose from, and that's typically their only option.
Right.
Right. But again, to your point, you're also normally not paying a financial advisor to be in a 401k and pick. So we think those are okay also. They're appropriate. So again, you're saving at your company, maybe Empower or Fidelity sponsors your 401k plan, and they offer you a menu of 10 or 20 mutual funds to pick from. As far as our clients are concerned, we're happy to help make those selections for them. But again, we're not charging an asset management fee on top of the mutual fund fees. We're letting them do that because that's their only option. And so someone that has a 401k, oftentimes you're forced to use the mutual funds, and that's okay. Again, we're not saying mutual funds are bad. Also, 529 plans, so college savings vehicles, typically all they offer are mutual funds. Mm-hmm. Again, we think you should cut the advisor out though and just pay the mutual fund company the fee. In there. Is there any other, I'm trying to think, I've got some notes here.
I would say people who don't have enough money to be diversified in stocks.
Very good, yes.
And I think maybe even a better alternative to a mutual fund in that situation would be maybe an ETF.
Right, so an exchange traded fund is what Jesse's talking about, or an index fund. They typically have far lower costs than mutual funds. And so we do like those for people that don't have enough money to go directly and buy stocks and bonds. How much money approximately would you say someone needs to have to be properly diversified and go out there and buy stocks and bonds?
I would say between 10, 15, 20,000.
Okay. Yeah, and I would agree with that. Probably around, if they're going to buy bonds too, maybe closer to 20,000.
Yeah.
So if you're just starting out, or maybe you're not starting out and maybe you're going to live off Social Security, but you've got, $5,000 in a savings account and you want to get better than what the bank's paying you, we think a mutual fund may be completely appropriate, right? Or certainly if you're younger and you're starting out, the idea is that if you have $100, you can't go and buy 35 stocks and 10 bonds. You're not going to be able to do that. But you can go buy a mutual fund that will go then around and turn around and do all those things for you. So you still get the diversification, you still get the professional management, even though you might not have the minimums to properly do it.
Right.
Now, for most of our clients, they're far higher than that as far as their account values. And again, that's the reason that we don't use mutual funds. We take on the money management in-house. Actually, Jesse's a big part of what he does for our clients is doing that in-house. We don't want to outsource that. Right. And we'll get into why we don't want to do that also. So again, takeaway here on this part of the show is that some of the truths about mutual funds is I know that a lot of the times that I'll pound the table and say that we don't believe in them for our clients, and we certainly don't, but that doesn't mean that they're bad. Right? So if you're a do-it-yourselfer, definitely would want to take a look at using a mutual fund. In your 401k, you typically almost always have to use a mutual fund. For college savings for your kids or grandchildren, mutual funds may make sense. And then again, if you're just starting out, or maybe you're not starting out, but you don't have a lot of money to invest in, then a mutual fund could be completely appropriate. And actually, according to my research and my understanding, that's why mutual funds were invented, was for the little guy, for the small investor, to be able to get proper diversification without having thousands and thousands of dollars.
Right.
In my opinion, Wall Street, as typically it happens, for whatever, if you want to call it good or bad, greed takes over. And that's why all of a sudden in 2019, we've got almost 10,000 mutual fund companies. Right. And then we've got all these financial advisors using them for their clients and charging double fees because you're paying an advisor fee and a mutual fund company fee, when in fact only one service is being done, and that's being done by the mutual fund company.
Mm-hmm.
Right? Okay. So again, mutual funds aren't bad in their nature. You just have to be careful how you're using them. So let's talk a little bit more, Jesse. I wrote down here the 5 top reasons that we don't use mutual funds for our clients. And starting with number 5, why don't you talk about what over diversification risk is?
Right, so that's being, I think we talked about earlier how mutual funds, they can oftentimes they have to own a lot of stocks because there's so many people invested in mutual funds that they have to maintain a certain amount of capital. So they could be invested in 200 companies within the S&P 500, and that over diversifies. So you're not really getting price appreciation when Apple goes up 50% in a year, because there's so many stocks in that portfolio that it's hard to really get that appreciation.
Yes.
I think was what you said.
Absolutely, yeah. And so over diversification is very much a real risk.
Right.
Also, if an advisor is putting you in 10 different mutual funds that all have 10 different investment risk profiles and objectives, and by the way, all 10 of these mutual funds don't talk to each other.
Right.
So now all of a sudden you might have Google in 4 different mutual funds, right? Or Apple in 3 of them, or whatever. And now all of a sudden you've got too much going on, or you've got thousands of stocks, which doesn't help you at all. In the end, it just makes it a big tangled mess, and your portfolio is completely inefficient. It's like if you were going to cook a dish at home, and you've got Italian ingredients, you've got Mexican ingredients, and you've got hamburgers. When you're cooking something, you don't put all of that in a pot and just light the stove up. But my opinion, when financial advisors buy 10 different mutual funds, they're just throwing every ingredient that they have in their kitchen in for the client, and they're claiming that that's going to help them. But in fact, it's making it a very, very jumbled mess. And in my kitchen analogy, a very disgusting meal.
Yeah, and even within mutual funds within the same company, they have different portfolio managers, and they're not necessarily going to be talking to each other and trying to coordinate their mutual funds. So, like you said, they could have Google and all the mutual funds for one company. It just depends on what the objective of that mutual fund is.
Right. So there's 2 factors. You get a jumbled mess, and then again, like Jesse said, these mutual funds get so big that they can't be concentrated. A lot of times they can't have 35 stocks because they have $1 billion in the fund, and if they had, 1/35 of that money in one stock and they went to go sell it, they would move the whole market in it. So they have to add all these other, smaller stocks around the portfolio just to keep their liquidity. And then what we found in doing mutual fund research is the larger a mutual fund gets, the actual more difficult it is to outperform.
Right.
It's a big problem in the industry. So if you are in mutual funds, you have to be careful, because if you're in a really big one, that actually might be hurting your performance, not helping it. This is actually counterintuitive the way a normal person would think.
Right.
Yeah, so big isn't always better when it comes to mutual funds either.
In most cases, it's worse.
Right. Okay, so that's reason number 5. Reason number 4, I have hidden fees. And before we started recording, you said that's probably, well, maybe not the hidden fees, but the fees are probably one of the worst reasons. But why don't you talk about some of the hidden fees in mutual funds?
I mean, if you're buying a mutual fund through a financial advisor, like we talked about earlier, you're paying the advisor fee and you're paying the mutual fund fee. So you might not necessarily see that mutual fund fee come out, but with equity, for equity mutual funds, it's about 0.6%, 0.63% per dollar you put in. And then for bond fees, or for bond mutual funds, it's about 0.5%.
Right.
That you're paying on top of the advisor fee that is on average about 1.02%. per advisor.
So financial advisors on average typically charge around 1%, which is pretty close to what our average is at Falcon Wealth Advisors. But if we were using mutual funds, you would tack on at least another probably 0.5% on top of that. So you're paying, 1.5 or 1.6% depending on what type of mutual fund you're in. And some mutual funds are actually over 1%.
Yeah.
Not all of them, but some of them. So you could be paying up to 2% for something that you definitely should only probably be paying 1% for.
Right.
And so these hidden fees you have to be careful of. And a lot of times the financial advisors, which is sickening, will just brush over them, right? They won't even tell their clients what their hidden fees are. I think an informed client would sit down and say, okay, I understand you're going to use mutual funds because you think they're best. Why don't you break out which each one of these fees are? And then what is that going to translate into a dollar amount on my portfolio? And I'll give you an example. If someone has $1 million, let's just say it's all in stocks. We typically wouldn't do that, but let's just say it's all in stocks and they're paying 0.63% to the mutual fund. Well, that's $6,300 a year that they're paying the mutual fund. And if the advisor is saying my fee's 1%, well, they're paying another $10,000 to the advisor. So they're paying, they're not just paying the 1%, they're paying the 1% plus the mutual fund. And we did some math, and basically over a 30-year retirement projection, that 0.63% on $1 million portfolio would cost the client $700,000 in unnecessary fees.
Right.
In fact, if you actually, the unnecessary fee actually is more the advisor fee, and that would probably almost be double. I mean, it'd probably be well over $1 million in unnecessary fees. And so, again, hidden fees are a big problem. We're not saying mutual funds are bad. It's when you buy them through an advisor who's charging you an asset-based fee or even a commission, and then you're paying the mutual fund, you're paying twice for the same service, which is completely unnecessary. And so that's a lot of that soapbox. But all right, so number three I've got on here, lack of control. Jesse, why don't you talk about control in a mutual fund versus the control the way that we do it?
Again, when you're in the mutual fund, you don't really have access to the portfolio manager, and the portfolio manager doesn't know who's buying the mutual fund, so they're not really beholden to you to meet any certain investment objective that you may have. So in contrast here, you always have access to me and Jake, who are the people who are typically running the portfolio. And we can walk you through decisions that we've made, or why we made a certain trade, or why a stock is in the portfolio, things like that you won't really get access to a portfolio manager at a mutual fund.
Right. You have no idea on a day-to-day basis what they're doing. With our clients, when Jesse makes a trade on the portfolio, our clients some of them have set it up to get immediate notification via email. Hey, we bought XYZ and we bought ABC. Or they'll certainly get confirmation in their statement. When you own that mutual fund share, the portfolio manager could be day trading your account and you have no idea what they're doing. Which to me, as a financial advisor, as a fiduciary-minded advisor, scares the heck out of me. Because I don't want my clients' trusted capital in some third-party money manager that has no idea what their goals and objectives are, right? We've got Tom Smith here, who's a retiree, and maybe they don't like communist countries and they don't want that in their stock portfolio. Well, you know what? Jesse and I can make that happen, right? Or they don't like AT&T or Verizon or whatever.
Or they do like X.
Yeah, or they do like X, Y, Z. Exactly. So we can, not only do we have full control over what they own, our clients also know what they own and why they own it. And they can put they're called investment policy statements saying, hey, I don't ever want to own X because I don't like that company, or I don't like that CEO, or I used to work there and I don't want to be a part of that. Well, when you're in a mutual fund, you don't have that control. And it's scary. It's scary to me as an advisor. And I would be certainly scared to trust if I was retired, to trust my retirement nest egg into a money manager that doesn't know anything about me. Right? And then when you're using 10 mutual funds, you're just compounding that. So now you have 10 different money managers that know nothing about you, all doing things on their agenda, not necessarily yours.
Which again isn't bad for them. They're doing what they're supposed to be doing with the mutual fund. It's an advisor pushing that on you, and it's not necessarily geared towards your investment objective.
Exactly. That's good. Yeah, because again, I'm not saying, I know it'll sound like I'm thinking that mutual funds are bad. Again, they're not. It's the advisor. You're exactly right, Jesse. It's the advisor as an intermediary. And what's funny to me is the advisor will put people in these funds and they have no idea. And how can you look across the table from your client and feel confident when you you can't answer to what those holdings are.
Right.
You have no idea what those mutual funds are buying.
Typically, you can see the top 10 and then
Right.
from there.
Right, and then that's only as current as whatever you're looking at that is published.
Right.
It doesn't mean that they're not trading right this moment. So again, I don't know as an advisor why you would use mutual funds if you're, or at least charging. Again, and maybe this is a good point for this side note. I think an advisor that doesn't have the competency or the confidence or the time to pick stocks and bonds for their clients, they certainly should consider using mutual funds. They just shouldn't charge a fee, right? Maybe they charge a consulting fee. Maybe they say, okay, for $500 a year, this is for my consulting and I'm going to go pick the best mutual funds, right? And that's much more reasonable than charging someone $10,000 when you're not doing any of the work.
Right.
So again, the whole point is mutual funds might not be bad. It's advisors charging enormous fees when they're not doing any of the work. That's good. Also, they're very tax inefficient. This is number 2 on my top 5 list. What I mean by tax inefficient is a lot of times mutual funds, if they do a lot of trading, they'll have to distribute capital gains. And if you own that, you may be forced to pay taxes on it, believe it or not. You have no control of this. And the mutual fund will do what's called a capital gains distribution, and you're taxed. Now, your advisor can do some juggling and try to swap you out of the fund and then do another one. But again, that just gets into unnecessary trading. And again, so they're known to be very tax inefficient. It's another reason we don't like mutual funds. And then the number one reason we don't like them is that, and we've already kind of talked about this, is they're not transparent. Why don't you go into what that means?
Yeah, like I just said a minute ago, a lot of times you can see the top 10 holdings, and that's typically it if you're not within the investment community or have access to institutional research. So you're seeing the top 10 holdings of this company, but you don't know what else they have in the portfolio. So I think that can be a problem because you have no idea what you own, which is a problem to me.
Yes, and it's scary to me as an advisor that I can't look across the table for my clients and rattle off all of the stocks that they own. I don't know how an advisor feels comfortable at night knowing that their money for their clients is being invested by these 10 different mutual funds or whatever they have them in, and they have no clue what stocks. I mean, that is crazy to me. That someone would feel comfortable with their retirement nest egg, trusting another professional that doesn't know how their client is invested on any given business day.
Right.
So this begs the question, again, and I already kind of talked about this. So if they said, Jake, okay, I hear what you're saying, but my advisor has said, you know what, Jake is wrong. You need mutual funds. They're really good for me. Then what is that person to do?
I guess you would, I don't know, honestly.
Yeah, and I guess it boils down to how are you going to compensate the advisor? It's like, okay, if this advisor believes that wholeheartedly in mutual funds, then perhaps you shouldn't be paying them an asset-based fee. You should just be paying them $500 a year or something.
Or ask them, why can't I do this myself?
Good
point.
point.
I can read. I can see growth. I can see value. I can see large cap. I can see small cap. Why can't I do it myself?
Right. Yeah, good point. So then maybe there's an initial setup fee. It's like, hey, these are the best mutual funds. We'll check them, every quarter, every 6 months. But again, you don't need to be paying an advisor to be putting you in mutual funds. It's crazy to me. And a lot of people though are scared because they hear, this is a big rebuttal I get when I'm meeting with a new client and I'm saying, okay, we're not going to use products. We're going to buy you stocks and bonds. And we typically like to buy 35. Why do you think there's this big misconception that people need to own hundreds and hundreds and hundreds of stocks to be diversified?
I think it's partly out of being scared because they don't want to be necessarily exposed to a certain company's earnings or a certain company's return over a year. But really there's a certain amount of sectors and there's a certain amount of industries, and a lot of those companies within those industries can feed off of each other. So groups perform together. So
interesting.
You're not going to you don't need 100 stocks within the tech sector.
Right.
There's probably not 100 good stocks in the tech sector.
Right.
So when you're looking at those sectors, you think that you need every stock in a certain sector to be exposed to it, but you don't.
Yeah, exactly. And in fact, we're going to put up on the screen right now a chart that I was given at the University of Pennsylvania's Wharton School, arguably one of the best institutions on financial education, about how many stocks it actually takes to be diversified. And on the vertical axis there, that is basically a ranking of risk. And on the horizontal axis, as you read this chart, has the number of stocks. And the line there shows you as how dramatically your risk will drop as you add stocks to a portfolio. So certainly if somebody puts all of their money in one stock, that is going to be risky.
Right.
But the chart here clearly defines that once you get to about 20 or 25 stocks, your risk, in fact, actually starts to flatline. And so the point of this is if you're going to be invested in the stock market, there's always going to be risk that you just simply can't get rid of, right? And that's okay. That's the whole point of why you invest, is to just try to get some reward, right? Make 7, 8, 9%. But the whole point of this chart is that you don't need hundreds and hundreds and hundreds of stocks to mitigate that risk. It actually, like we talked about earlier in the show, it actually starts to hurt you because the portfolio manager is so tangled they can't manage the portfolio efficiently if you've got too many stocks in there.
Right.
So again, we at Falcon Wealth Advisors, we believe in owning 35 stocks. We believe that that'll cover the sectors efficiently for us and for our clients, and we've proven it. Our performance is, it's done fine for our clients, and in the end, we're just looking to meet each one of their individual objectives, and that's again what's most important to us versus outsourcing it to a mutual fund company.
Right.
And also because we're not doubling up their charges, we're not charging them 1% or increasing their charges by 50% or whatever you want to look at it, it's much easier for us to hit their target because their fees are typically a lot lower, which again is very, very important when you're looking at investment performance. What else have we looked at here? Or did I miss anything?
I think we got everything.
We got a lot, didn't we?
That was a lot.
Now, there is one other thing that I wanted to point out, I think, in here before we get into our fun topics, is also you want to be careful if your advisor is using a hodgepodge of products. I've seen that in certain portfolios where an advisor will have index funds, mutual funds, bonds. They might add annuities. They might start adding individual stocks. And then people come in with these statements and I'm like, oh my gosh, what is this advisor doing? There is no investment policy or theme going on here. It's just like they're throwing a bunch of products at this person and they're just buying whatever they're selling them.
Right.
Do you have any comments on that?
I think it's interesting when clients or people come in and they're prospective clients potentially, and they have like a stock or a few stocks, like they'll have Apple and Google in their portfolio, but they also have mutual funds that own Apple and Google.
Right.
And it doesn't make any sense.
Right. And if an advisor is going to use mutual funds for stocks, but then go buy bonds on their own, why?
Yeah.
So in one hat, you're saying you're competent to manage bonds, but in the other, you're saying you're incompetent to manage stocks. And then you throw in index funds, which are completely different than mutual funds or bonds. And it turns into this just product push portfolio that you can just screaming fees.
It looks like they read like a Finance 101 book and threw in every word that they saw in that.
That's funny. Again, going back to the kitchen, they're trying to make a pasta dish, but they're putting hamburger buns in the pasta and they're putting, fish, or I guess fish could go in pasta, but enchilada sauce or taco shells, and it's just a jumbled mess. So in the end, again, you've got to be an informed consumer. Do your homework. Stocks shouldn't scare you. Mutual funds buy stocks. What should scare you is not knowing what you own or being over-diversified or your advisor charging you a fee on top of mutual fund fees. That's very scary in there. Now, I want to get into the fun topic now and switching gears, but this does coincide with our conversation today. I'm reading a very fascinating book called Alchemy, and it talks about you and I I think we've done a really good job of rationally explaining why people probably should be very careful of buying mutual funds from advisors. But why do you think people still do it?
I think I think one thing that I've read about is like people are more scared to lose $100 and the loss of $100 is like worse than the gain of $200 would be.
Yes.
If that makes sense.
Absolutely.
So people are just scared of losing money, whatever it may be, losing a game, whatever it may be.
And they hear stocks and they think more risk.
Yes.
Like you talked about the herd mentality and going together.
And you hear 100 stocks and you're like, okay, even if one fails, I still have 99 left.
Gotcha.
But it doesn't help.
It doesn't help, right. It actually makes it harder to manage. Very interesting. Right. Yeah, so the book is fascinating. It talks about that we as humans make irrational decisions all the time, and that's fine. But it's fascinating to me that I can tell them the facts and this is what's going on and this is what we're doing. And I can even show it to them And it's sometimes in the end, they're like, Jake, I'm going to go buy an annuity. Right. I get what you're saying, but I'm going to buy an annuity. So I think you have to be careful that fear and greed don't dictate your investment decisions. And that's really what it's boiling down to, is that people get scared or they get greedy. And, that dictates their decisions. And in the end, they could be making a very, very wrong decision, costing their family thousands and thousands of dollars because they let fear motivate them.
Right.
It's just bad. So, all right. So fun topics. We just did the lightning round, so I didn't want to spring that on you again. Do you have anything you wanted to share? I know you got a puppy dog. How's that going?
Yeah, the dog's doing well. She actually bit me on the mouth. There was a little.
Oh no!
There's like I don't know which side it was on. I can't remember.
What the heck were you doing? Were you petting her or picking her up?
We were just on the couch, and she had her mouth open to like bite, and I also turned in, and it was bleeding a little bit, but it's fine. She's really great. She's doing well in her training. She's a golden doodle. Like
I totally copied Jesse, by the way.
But yeah, we both have golden doodles now. But mine's a girl. Yours is
a boy. Yeah. And what's your dog's name?
Lucy.
Lucy. Was there a reason?
No. That was just that. I had a few names, and that was the one that the most people liked the most. So.
No Beatles, Lucy in the Sky with Diamonds. I know you're not a big Beatles guy.
Not a big. I don't even know what that reference is.
That's a song. Good one.
Well,
it's a good song.
Maybe I'll listen to it after this.
So you're enjoying your dog, and you mentioned before you're reading. I know you read a lot. What book are you reading right now?
I'm reading. It's called Misbehaving by Richard Thaler. It's about kind of what you talked about with people not making rational decisions. And I just finished a book called The Tipping Point by Malcolm Gladwell that I had read earlier. I just wanted to reread because I do like his books. Yeah. And I kind of forgot a little bit about that one. So
that's interesting. I noticed you reread books somewhat often. Is that, why is that? Is that for just entertainment, or you forgot something and you want to hone in that message? I'm just curious.
So I'll kind of like cycle through books. So I'll read it, and then 2 years later I'll reread it. I think I want to solidify the information, especially on some of the books that I read. They're really interesting, but a lot of the topics can be a little heavy, so you have to kind of reread so that you can really understand it. So I reread for understanding a couple years later after I've forgotten it, and it's still interesting.
That's awesome. Do you underline and highlight in books at all?
Yeah, sometimes I will.
Gotcha.
It depends on the book, though. So like fiction, I'm not highlighting or underlining.
Right, good point. So I started this documentary last night on Netflix about Bill Gates. Have you seen that one come out? It's pretty new. And he reads a ton, as you would imagine. He reads 150 pages an hour. Do you know what your speed is? You got to be pretty fast if you're reading a lot.
Yeah, I don't know. I've never tried to track it.
My wife is like lightning pace, and she reads 100. She's like, I was like, how do you know that? She's like, I just know from how much I read. Like, if I got 100 pages left, I know it'll take me about an hour or whatever. I have no idea what mine is. I would say 50, but I was just curious if you knew that.
Yeah, I don't know. I never tried to track that.
But we were both fascinated that he's reading at 150, because that's a lot. Rachel's really, really fast. So anyways, it's interesting. It's fascinating to me, and thank you for letting me copy your pooch and get a golden doodle. They're awesome dogs, aren't they?
Yeah, they're just really good dogs. They're easy to train. They're really smart. They have the retriever in them. They have the poodle. So they're just
hyperallergenic. I highly recommend it. And are you finding? I know it's tough because you're raising your dog on your own, but are you finding a lot of more joys come to your life?
Yeah, I think there were a few weeks or a few days where I was kind of questioning my own decision, but I think the more you put into it, the more you'll get out of it, just like with anything. So like the more training I do with her, the more I enjoy her. So I think it's been really good.
Do you think you could flash up a picture too for our audience?
Yeah.
Perfect.
I can do that.
Perfect. So we'll share a picture of Lucy, because I've already shared Einstein on here also, my dog. Okay, perfect. So that's all. Thanks for sharing that. That's all the time that Jesse and I have for you today. But again, as always, thanks for tuning in. If you're watching this on YouTube, please make sure you subscribe. And if you think it's worthy, give us a thumbs up. We're also out there on Spotify and iTunes podcasts. If you want to give us a 5-star rating, we really appreciate that as well. We're out there on social media platforms like Facebook, Instagram, Twitter, and LinkedIn. And you can find me out there on Twitter at Jake Falcon CRPC. And if you want to have any questions for Jesse, I believe email is his preferred method. And Jesse, what's your email?
Yeah, my email is just Jesse at Falcon Wealth Advisors.
Perfect. Thanks again for joining me on episode 63. And thank you all for tuning in. And we hope you all have a great week.